Welcome back to another lesson. We continue with our revision series, and in this video we are going to look at question number 4, that is CHRP 04 Introduction to Financial Accounting, and this exam was done in June 2021. Now, our focus is question number 4, and it reads, explain the following terms as used in cost accounting. The first term you're supposed to explain is, what is a cost center? What is a cost center? Now, when you're talking about a cost center, this is a department saying that is a department within a company, which is not directly going to generate revenue, and profits, but it incurs some expenses. Yeah, but we're saying that this is a department within a company which is not directly going to generate revenue and profits to the company, but it still incurs some expenses. Incur expenses to the company for its operation. So that is a cost center. We are seeing that in a company. Let me give a good example. Like when you're talking about the accounts department. The accounts department in a company will incur expenses, but they are not directly involved in generating revenue. Yeah. So if you go to production department, they are involved in generating revenue. You go to marketing department. So accounts department can be considered as a cost center. Next is, what is a limiting factor? Supposed to explain what is a limiting factor, and this is a resource. Which is scarce. Is a resource which is scarce in supply and may include labor hours, talk of machines hours, raw materials, funds, etc. Is a limiting factor because it limits the performance when it is in shortage. Yeah. So you're seeing that it is a resource which is scarce in supply and may include labor hours, machine hours, raw materials, funds, etc. The next thing you are supposed to explain here, what is a profit volume ratio? What is a profit volume ratio? Now, this is a financial ratio. That measures the relationship between the company's sales and profits, between the company profits and its sales. When you're talking about the profit volume ratios, we are looking at the profit, the ratio at which the profit is derived from the company's sales. Yeah, that is what the profit volume ratios refer to. The next item you're supposed to explain here, what is a margin of safety? When you're talking about margin of safety, when you're talking about the margin of safety, we are saying that it represents the maximum. It represents the maximum amount by which the actual budget, it represents the maximum amount by which the actual sales can fall below the budgeted sales. And in this case, there is no loss incurred by the company without making any loss. In other words, to make it clear here, when you're talking about the margin of safety, we are talking about the sales beyond the break-even point. You see, at the break-even point, that means the company expenses and revenues are at par. So that means those sales that are above the break-even point, yeah, they are the one we are referring to as the margin of safety. In this case, we are saying that it represents the maximum amount by which the actual sales can fall below the budgeted sales without making any loss. That is it. Finally, here you're supposed to explain what is gross profit margin. What's a gross profit margin? Now, when you're talking about the gross profit margin, we are saying that it is the profit after subtracting the cost of goods sold. The cost of goods sold. In this case, we are saying that it is the money. It is the money a company. It is the money that the company makes after accounting for the cost of doing business. After accounting for the cost of doing business. For the cost of doing business. Now, that is it. We are saying that when we're talking about the gross profit margin, it is the profit after subtracting the cost of goods sold. Now, otherwise, so it's the revenues or sales after subtracting the cost of goods sold. That is it about that part. Part A, you're supposed to explain those terms. When you go to part B, you are told that the books of Karonzi Enterprises had the following balances at the beginning of September 2020. There is balance brought down, there is contra settlement, there is received a check, received cash, bad debts written off, sales, dishonored check, discount allowed, returns inwards. Here you are told to prepare sales ledger control account. Now, a sales ledger control account, it can also be referred to as account receivable account. This account receivable, that is sales ledger control account. Of course, this side is debit and this side is credit. Now, let's look at items here. You are told that there is balance brought down. Balance brought down for account receivables is a debit balance. So here you are going to have balance brought down 861,000. Then there is a contra payment. We're not talking about a contra payment here. Look at this. You have a supplier, and at the same time, the supplier is your customer. Yeah. Let's say that your supplier, you owe your supplier that 1,000, and he also supposed to pay you that 1,000. You see, at this point, there is no need of you paying him and him also paying you. So you can just do what we call contra. This is a contra settlement. That means you have settled without necessary payment or transfer of cash. Now, since this supplier was accounts payable are supposed to be credited. Are supposed to be credited because they are liabilities. Account receivables, they are supposed to be debited. Now, what happens when you want to reduce your debtors, or you want to reduce? So what you do, you credit your account receivable and debit your accounts payable. And since we are dealing with the sales ledger, it therefore means the contra payment here, we are going to credit because ordinarily when you have the account receivables, they have a debit balance. When you want to reduce them, you credit. So we are going to credit this contra agreement. Here we can, this one we can talk of, this is contra settlement. Contra settlement, this is like you are settling your accounts payable. Yeah. So contra settlement, and by how much amount? 377,000. This is 377,000. We move on. You received a check. What happens when you receive a check? The check is meant for payment. That means when you receive a check, it's supposed to reduce your debtors. Therefore, it is going to be on the credit side, because anything that is reducing your debtors or account receivables goes on the credit. So once you receive a check from bank, then means that you need to, here you have this is, you call this one this is check goes to bank. This we can call a bank check. This is how much? 900,000. Now you received cash. This also goes to settle your debtors. That means they have reduced the amount of debtors that you have. So received cash 58,000. Bad debts written off. When you write off debts, that means you have reduced the amount of debtors you have. You have written off some debts. So by writing off debts, you reduce, this is bad debts, you reduce your debtors. So you credit with 18,500. Dishonored check. Now you see, with the dishonored check, you had cleared, you had credited your account receivable by the fact that you have received a check. You see the check here, like the previous example, the check here was on the credit side. But at this point, the check has been dishonored. It therefore means the debtor still remains. Yeah, we still have dishonored check. Dishonored check. Dishonored check will be debited because this amount has not actually reduced your debtors. Same thing with sales. Sales increases your debtors. There was sales figure here was missing. This sales figure here is supposed to be 1,350,000. Sales figure here increases. This sales figure here increases your debtors. Now, discount allowed. When you allow discount, it means you have reduced your debtors. You have reduced the amount of sales. It therefore means discount allowed is supposed to be credited. Discount allowed. Discount allowed, how much? Discount allowed, that is 200. Finally, you have what we are calling return inwards. Yes, what happens with returns inwards? You had made some sales, and these sales were debited, assuming they were account receivables. Yeah, because you credited sale and debited account receivables. But now, since sales have been returned, it means the amount of debtors also have reduced. So you come here and you credit the account returns inwards. Returns inwards. Returns inwards 146,000. So I have captured all the items in my ledger or in my account here. So I have to balance them. Let me see. If I take the debit side, 861,000 plus 55,000 plus 1350, 1.35 million. This is giving me 2,266,000. When you come on the other side, we have 377,000 plus 900,000 plus 58,000 plus 18,500 plus 37,200 plus 146,000. That is 1.7 million. So this means the balance carried down will be on this side, 2266,000. So there is a balance carried down of 562,800. So that you balance your account. So that is it. That's how we prepare sales ledger account, sales ledger's control account, and that marks the end of that question. We meet in our next question. Goodbye.